Most traders mark a level on their chart, price comes back to it, they enter immediately, and they got stopped out. Then price reverses exactly from that level without them. That is not bad luck, that is a timing problem. Today we are talking about the successful decision point, the SDP, and exactly how to know when a level is ready to trade and when it will destroy your account if you touch it. A decision point is a price level or a price zone where the market made a significant decisive move in the past. At that level, one side dominated. Either buyers overwhelmed sellers completely or sellers crushed buyers, and price left the zone with momentum and conviction. That departure leaves a mark on the chart. It is institutional memory. The market knows that level existed, and when price returns to it, a battle will happen there again. But here is what most traders miss. A decision point alone is not a trade signal. It is simply a location of interest. What you are waiting for is the market's verdict on whether that level still has the power. The verdict is called the successful decision point. A successful decision point is a decision point that has been tested and confirmed. Price return to the zone showed a specific and readable reaction, a weak rejection, a bearish engulf, a pin bar, and then moved away from it in the original direction. That reaction candle is your confirmation. That is the market telling you the level is still alive and defended by the institutional orders. Without the reaction candle, you have a location, not a signal. Without it, you have an SDP. That signal distinction separates traders who time entries well from traders who are always one step behind the market. Condition 1: the origin must be clean. The move that created the zone was sharp, fast, and impulsive, not a slow grind, not choppy overlapping candles, a decisive, one directional thrust that left the zone without hesitation. That tells you real institutional interest existed at that price. If the origin looks weak, the zone will likely not hold on retest. Condition 2: the return must be structured. Price does not crash back into the zone in the same direction it originally moved. It returns in controlled, corrective manner, measured, calm, step by step. A slow pullback means the original participants are still in control and absorbing the retracement. If price smashes back into the zone with the same force it left with, that was a warning. The level may be getting broken, not respected. Condition 3: there must be a reaction candle. When price reaches the zone, something visible must happen on the candle. A rejection wick, a bearish or bullish engulfing candle, a strong close away from the zone. This is not a suggestion, it is a requirement. The reaction candle is the final confirmation the institutional order is still sitting there and being defended. Without it, you are front running the market. With it, you have an SDP. Let's walk through a real example. Here we have GBP USD on the 4-hour chart. Here price dropped sharply from this level. Strong bearish candles, no hesitation, clean impulse. That is our decision point. We draw the zone from the body of the origin candle to the weak high. Now watch the return. Price retraces slowly in controlled zigzag. It is not aggressive, not impulsive. It is a corrective move. Condition 2 is met. Price reaches our zone, and look at that candle, a bearish engulfing candle. Price entered the zone, got rejected hard, and closed below the zone low. That is our reaction candle. Condition 3 confirmed. At this point, we have successful decision point. All three conditions are present. Entries taken at the close of that engulfing candle. Stop sits above the zone wick. Target is the next significant draw on liquidity below. Clean structure, no guessing. The setup told you everything before price moved. There is one mistake that costs traders money on this setup every single week. They mark the zone, they see price returning, they get excited, and they enter before the reaction candle. They front run the confirmation. Price then pushes deeper into the zone, hits their stops, and then, right after, the reaction candle forms and the move begins without them. Waiting for the candle to fully close is not weakness. It is not being slow. It is the rule that keeps you in the trade when it matters. Every pip of slippage you avoid by being patient is a pip that stays in your account. Discipline at the entry is what separates the SDP from just another failed level trade. A successful decision point is not complicated concept, but it is a disciplined one, a clean origin, a structured return, a reaction candle that confirms the level, three conditions, one entry. That is this system. If this gave you a clear picture of how to time your trades at decision zones, hit the like button and follow for more price action content every week. Drop the comments. What pair are you going to apply this on first? Every comment gets read.